Thank you for joining us today, everyone, at what I think may be one of the last panels of the conference. It's glad to see everyone who's survived this far. A quick introduction of myself. So I am Sean Fedorko. I'm a political scientist who made a hard pivot into innovation. I founded and led a co-working space and an incubator for 6 years, and then a little less than 2 years ago, I was invited in to help lead Erie Insurance's new innovation team, including our recently announced venture capital fund, which we've launched in partnership with Touchdown Ventures, and is how I came to be with you today, filling in for Rich Grant of Touchdown Ventures, who couldn't be here to moderate this panel. So with that, I'll jump right in. Our panel's topic today is innovation and product development for property insurance. And I'm excited to moderate for a great group of panelists. And I do encourage the audience to ask questions. Just raise your hand, I'll call on you, and you can shout. You can do that at any point during today's conversation. So at this point, I'll just ask each panelist to provide a brief intro, about 1 minute each, and mention one or two of the nuggets on how you are driving innovation in the property space, and I think we'll just take it left to right.
Thanks, Sean. So I run a company called Kin that I started 6 years ago, which seems like 100 years ago. And we do homeowners insurance. And there's sort of two innovations that are going on. The first is a business model innovation, and that is that we are direct to consumer. The reason why we think that's a good model for this is because it allows us to have a cohesive view and actually use marketing as a lever for risk selection, which doesn't happen in the industry currently. In insurance, it happens in a lot of other financial products. The other reason is that the insurance agents are very overcompensated. They are an amazing business. Like that, being an insurance agent is a much, much better business than being an insurance underwriter. You'll often see 40% plus EBITDA margins, whereas the underwriters are sort of maybe 5 across the cycle. So we can keep that and make ourselves a really high margin business, return some of the savings to the customer. So that's the business model innovation. And then the technological innovation is that there's lots of data out there about homes and people who live in them, but it's all unstructured. And so what we've built is a lot of technology that takes that unstructured data and turns it into structured data that can be used for much more accurate pricing, underwriting, and also marketing, to make sure we're marketing to the customers that we want in our portfolio. And that's very different than what happens with the existing industry, because they're still very reliant on user or agent input data. And that actually sounds like a small thing, but it's actually a really big thing, because it fundamentally breaks the actuarial models. The actuarial model is basically correlation analysis. Okay, when you have the dependent variable, that's the claims. Presumably every insurance company knows what their claims are, but the independent variable should be the true facts about the risk about the loan. And instead what it ends up being is a proxy for that, which is what the agents tell me about the loan. And there's a lot of inconsistency. So that's a lot to it.
Thank you. It's nice to meet everyone. I'm Adarsh, Rachmaile, co-founder and CEO of Covertree. We're focused on being the insurtech for Middle America, specialty personal lines of insurance that you might see in rural areas, not so much in major metro areas and major cities. Our marquee line is manufactured homes. So if the home's built in a factory and shipped on site, hooked up to utilities, we're the only company that can help insure that digitally. It's things like modular homes, ADUs, tiny homes, etc. It's a big market. You might not see it every day. It's 22 million Americans, but we believe it's the future of the way that we'll live. Every year we're moving more and more towards modular and manufactured construction, but traditional insurance and insurtechs just aren't focused on it. So that's our niche. And the second part was, how are we innovating on underwriting and products? So I'd say the first thing is on data. Manufactured homes is an atypical market. We don't have access to data the same way there is for auto or homeowners. And so buying data, enriching data, geofencing communities, getting really granular about our data set is really big for us. And so making that proprietary is key. I would say we probably have some of the most data for any manufactured home company. And the second is underwriting via distribution. So Sean's an investor in Covertree, but our businesses are different because he runs a pure D2C business. We have D2C technology, but we leverage it via big distribution partnerships, the landlords who own communities, the lenders, et cetera. And so what we do is we underwrite via distribution partner. So we have a whole bunch of distribution partners. We figure out whose risk do we want to take? How nice is this community? What kinds of homes are they lending on? And as a result, we have to do a lot less manual underwriting on our end. Yep. And that's it. Thank you for having me.
Awesome. So I'm Itai Ben-Zaken. I'm the co-founder and CEO of Honeycomb Insurance. Honeycomb focuses on the habitational market or multifamily property market, a market that has been, I'd say, traditionally very old school and run like the regular commercial lines business, but in many cases you're talking about risks that are actually not very far from a homeowner's policy in size. So we built a deep technology platform to allow us to underwrite in a way that streamlines the process, but also continues to keep the integrity of underwriting, because eventually these are assets that if we lose 10 assets, and it's a very painful loss. So we still have to have the discipline and the rigor of regular underwriting, but we are creating that with artificial intelligence technology that basically builds that knowledge and is able to apply it based on what we know from traditional underwriting. So we have roof models and front models, and we have models that we use on top of imagery that comes from within the building that we do remote inspections on. And that's really the core of our differentiation. It's underwriting. It's a product that can kind of bridge the gap between loss ratios and huge expense ratios, low loss ratios, huge expense ratios, or low expense ratios, but then all of a sudden, loss ratios blow away. Our technology bridges that gap and allows us to do both.
I'm Dan Woods, CEO, founder of Socotra. Socotra is the Insuretech movement's answer to broken legacy policy administration. We bring things that shouldn't be surprising or impressive to the industry because they're found in other industries, like actually documenting what you do on your website, being in the cloud, continually upgrading, things that anyone would expect from any piece of software outside of the insurance industry, we're bringing to the insurance industry. We work with a lot of incumbents, MGAs, in the last 18 months. 27 MGAs have chosen Socotra to be their system of record. In terms of what we're doing to enhance productization, I'd have to take the mic back up to Adarsh, because they're a customer of ours, and I'm the tech guy here. I empower people like this to do the things that they do, and that's our contribution, is to get out of the way to allow them to have their business dreams actually fulfilled and to meet the needs of their customers.
I think a lot of people look at insurance like, why is there not more patient? And to me, it really comes down to two things. The first is there's not as much competitive intensity. I think the main reason for that is the regulators set up a lot of rules. There's lots of regulators, right? And they're missing, in fact, the side effect of the rules, all these rules and requirements, is that they really eliminate a lot of competition. So there's not a lot of competitive impetus. They don't have to. They're doing fine, actually.
Yeah. And a lot of them are not for profit, of course.
Exactly.
Yeah.
And then the other big problem is that their core systems actually don't accommodate the innovation. And that's why I think, eventually they're going to need to replace their core systems. They're very bullish that companies exist.
Thank you.
That's why isn't there more? Well, it's because their technology simply can't do it. And new platforming is really, really hard if you're a big company.
Yeah. So there are some barriers, but of course there's also some low-hanging fruit. And there are various approaches toward innovation. What do you think is the lowest hanging fruit in this space? Is it distribution model, tech, segmentation, other?
I think it really depends on the market. But in our market, I'll tell you that the biggest low-hanging fruit. Am I too quiet? Is this better? All right. No, in our market, the low-hanging fruit is the discontinuity between marketing and underwriting. But I suspect it's different for each of you guys.
Yeah, for us, it's goes to my, my first answer from the first question that you asked. It was distribution channel. At the end of the day, we have a certain amount of consumers coming in and seeking policies and quotes. And so controlling the top of the funnel, I think, is definitely the easiest part. Who's coming in? Who's coming to our site? Why are they coming to our site? Controlling that through partnerships is definitely the way that we do it.
Yeah, I mean, for us, it's really about that technology piece that's missing. I completely echo what Dan mentioned about the systems. If you think about the incumbents, they sit on top of 20 legacy systems, so it's very hard to work. We bridge that because we do have a system that we can control. But I think the remaining big challenge in our market is that there's really good manual underwriting. It's super expensive. It's inconsistent. And the downside could be really huge, right? If you're insuring $10 million buildings and they get destroyed, that's a really big blow. So you really want to move away from any such risk. And the way that insurance companies have done this so far is either by, just manually underwriting everything, sending inspectors to 100% of the properties and then remaining with a very tiny margin, or taking a risk, getting hit, and then pulling out of the market. We've seen that a lot. There's no leader for our market. So the low-hanging fruit in our market is figuring out how you're able to automate. You don't have to automate 100% of the process, but really automating without exposing to those big downside risks.
Yeah, the thing is, this is really, really hard. It's a very complicated product with a lot of infrastructure and stuff that's going on behind the scenes. Now, the other side is that customers don't expect very much. So we talk about these innovations, and it's really basic stuff. It's I'd like to build a client without it taking 3 weeks. I didn't even tell you that. The legacy.
Yeah.
That's great. That's a really reasonable expectation. So the stuff that customers are asking us for is really, really basic. But actually fulfilling those basic expectations requires a huge amount of infrastructure and really a lot of plumbing that is hard to build. It's taken some of us a really long time to build it. I know, Dan, I think you started this, 2014 or something?
Yeah, 14.
It's not easy to build a really good core system.
Yeah, I mean, it's a bit like you make a change to an airplane, right? I mean, yeah, theoretically, change that, engine, or, make the steering wheel go a bit to the right. Well, you want to be sure that you don't mess things up. So some of those basic expectations do take time because we want to do them in a way that we can control and that our reinsurers, appreciate and understand. Yeah. No, I mean, so that's, I think, a big inhibitor for innovation. Combine that with the fact that the current players are, on average 100, 120 years old, and they haven't been bothered too much until recently. They're like, what, it works. I make money, I invest it, the stock market goes up, so why should I change things?
Yeah. I was also going to say that the policy administration problem is also, as I know firsthand, a lot harder than it looks at first. The entire first wave of insurtechs built their own. And part of it is they didn't have a lot of options. Look at the options available to them, of course. But now, I mean, I'm in touch with half of them because they're now legacy. And they're like, this was great when it was starting blank slate, build something quickly, and they didn't have the many options anyway. But now they're managing legacy just like everyone else and trying to figure out what to do with that. Even the field amongst policy administration was significantly more crowded. I spoke with someone today who claimed that a client of his, he's a consultant, had examined literally 50 of them. And we've been seeing, as the insurtech movement has matured, there's definitely been a consolidation that has been accelerating.
Yeah. So I appreciate that, and you didn't just touch on some of the low-hanging fruit. You talked about some of the barriers to seizing those opportunities. Tell me more. So one of them is, of course, a legacy technology barrier. Sean, you mentioned the regulatory barriers. But maybe talk a little bit more about how incumbents are in their own way, and about how the upstarts are challenged to enter a well-established legacy market.
Well, I think so. I come from the fintech world, and I think one thing that really unleashed a lot of innovation in fintech was that you began to get banks that were willing to make their infrastructure available as a service to the tech companies. And you really don't have that in the same way in insurance yet. So if you look at like PayPal or a very early payments company, they had to build all that banking infrastructure themselves. And by the way, they had to do it completely outside of the regulatory framework. They were originally using like sketchy settlement to process their payments. I think this is sort of where we are now in insurance. And now if you want to start like some innovative payments companies, all the plumbing is there, so that you only use this API to this one. I think there's some real regulatory impediments to providing those APIs. One of the big ones is the need to, for many of our products, file a rate plan, and the need for the regulator to have each insurance company only have one rate plan. So that would make it really hard if I wanted to say, I'm going to spin off from Kin and then create an insurance as a service thing. There are other companies that are doing this, right? But the one rate plan per insurance underwriting company is a limitation that I think is really limiting us. Because then you ultimately end up needing to set up an insurance company or a MGA relationship. Each of us have been through this, and it's really hard. We set up an insurance company, and then a year later we finally got regulatory approval for that. And by the way, we still have file rates and forms after that. So just I think there's quite a lot that can be done. That would be a really good starting point to eliminate that constraints.
I can hit this next. I have two answers. One is tech, and one is more of just a traditional answer. Tech, we use Socotra, we use Dan's product, and so that allows us to spin up new states in like a tech sprint, like in the matter of a sprint, which is amazing. And then our ability to do rate changes is the same, right? We're still dealing with the same DOI, but at least the way that we log it in our system and the way that we can push it out is very quick and rapid. And so as a result, we can get into more states quicker, we can look at our data easier, and we can go back and make those corrections easier. So that's on the tech side. So that's thanks to a great pass system and the way that we've architected all of the data. It's very organized. The second, I think, thing is, so obviously that's stopping incumbents because it might take them a couple months to launch a state. And when people need insurance, and Sean knows this because sometimes you have to act fast to enter in certain states, you need to be in that state. The second is more of a traditional answer. It's an alignment of incentives, which is really stopping legacy carriers. So in our example, we're a specialty insurance company. Usually a specialty policy goes from a carrier to an MGA to then a wholesale distributor, then it goes to an independent agent, and then it goes to the consumer. Everyone is monetarily incentivized the same. Everyone wants to make money, but their actual goals are different. What ends up happening is the independent agent comes down all these rungs of where the policy is hit, and they don't really care about the consumer. And the incentive structure isn't aligned that way. And so I think for a company like us, we're nimble. We change that incentive structure. We work directly with the consumer whenever we can. We're niche focused. We give them a great customer experience. And so hopefully as we grow, we don't also fall into it. It might be inevitable, but for the near term, I think that's something we can avoid.
Yeah, I have a question actually. I'm turning back to you because you're actually the person who works for the legacy insurance company. So Erie set this innovation thing up recently. Why not?
Yeah, it's a great question. So from Erie's perspective, we see the opportunity in strategic partnerships. There's a great compatibility between the advantages of a legacy provider, which has enormous credibility, a distribution channel, which has all of the products at its disposal to bring into those new states. It has all the expertise to deliver a really quality product and service. But there is, of course, innovation, and maintaining that legacy system is hard, and updating it is hard. We talked about the plane. Yes, you can update the engine, but you're flying the plane, which makes it a little more difficult. And so one of the best ways I think that incumbents can succeed at innovation in this space is by not resisting or competing directly with the upstarts, but finding ways in which there's a really great synergy. Well,
I think
go ahead.
I say that the airplane analogy. I think that there's what shapes the culture is the incumbents are like in a flying plane, where the most natural thing to do is don't touch anything. Startups are in a failing, crashing plane that is going to be a crater if you don't fix it in the next period of time. There is no steady state with a startup. Every startup is either a virtuous cycle or a vicious cycle. And you start with broken, you start with zero. And it's on you to do something from there. And that creates an urgency and a singularity of alignment that is extraordinarily powerful. As I tell my team, like we have 3 core values at Socotra, which are improvement, reliability, and pragmatism. And as I tell the team, what that really means is we need to take every small company advantage we can.
No, I appreciate
Culture.
Your culture, I would say, first and foremost, your culture of innovation. And we've been talking broadly about innovation in the industry, but maybe we'll touch on some more specific themes. So in particular, there's a lot of talk around big data and unstructured data, like video and images. What do you all see as the biggest opportunities for big data, specifically within the property space?
I think the biggest opportunity is to use it for marketing. And the reason why is that everyone always says, oh, big data, and then they jump immediately to underwriting and pricing. Now, the issue is underwriting and pricing are both very heavily regulated. So even if you have a big data model, so I'll give you an example. We've actually run this analysis. We found out that the domain of your email address is predictive of your risk. Okay, what do we do with that? Right? If you have a file.
I want to know what a Hotmail driver is like.
Yeah, well, so the local ISPs are bad. And like Yahoo, those are good at all the Gmails and we can't file them in the state insurance regulator. There's no way to do a lot of that. And there's lots and lots of these examples. And so that's why I think actually the best use of this is to target the right customers by using that big data. It's the feedback cycle. And also, by the way, you can get state regulators to allow you to use a new factor. Not that, obviously, that was silly, that's why you use it, but there are other factors that are legitimate that are related to the risk. But now you're entering like a multi-year feedback loop to get that into time, if you're doing it at once. And that's, I think, really problematic, and that's why I say marketing, because the feedback loop on marketing is much tighter and also much less constrained. Obviously, there are things you can't do in marketing. I can have a machine learning model that like discriminates against people, right? Like we've seen this more in the world. That's not allowed. But you can do a lot more than you can when you're asking a regulator for approval of is this an appropriate discount to give for X factor.
Yeah, I mean, I think that the biggest kind of opportunity to accelerate around big data for, across the board in insurance is having a more structured database of a lot of the information that insurance companies want to use. I think, Sean and Kim built something that is their differentiating factor, but I imagine they haven't, they probably built it for themselves for the purpose of what makes the biggest difference for them. And same thing with us, we build it for what we care about. I think in the early days of Google, they came up with their mission statement that they want to organize the world's information. And initially, people criticized them. It's like, this is a bit aspirational. They did it. In the insurance world, I think there's still a lot of progress that needs to be made because all that information is out there. It's in the counties, it's in tax records, it's in a lot of different places, but just messy. One state has different rules. One of them has it online. One of them you have to go and take the files in paper. If that progresses in the same way that Google progressed some of the more straightforward information, like you go on Google Maps and you type a name of a restaurant in any part of the world and you get the same data, then I think that allows startups, but also incumbents to accelerate. Right now, I think it's a big inhibitor for moving forward.
So I appreciate that. I'm going to ask maybe just one more question, get one or perhaps two brief answers, and open up questions for the audience. Embedded insurance is another major theme recently, and are you seeing this in property, and maybe particularly around distribution?
Yeah, I can take this because this is our bread and butter, which is partnering with a lot of these landlords and embedding in the move-in process and the renewal process. It's more difficult than it sounds because at first you think, okay, you put in a little link on the lease and then you put it in the leasing packet and people will buy it. But non-surprisingly for a lot of people, actually, it's more difficult, right? It's about getting in front of them at every opportunity. And so a big thing for us with embedding is we get embedded, but we make sure that everyone that we're partnered with knows who we are. Every manager of every community knows who we are. There's a trust factor built in, because seeing an insurance company and seeing it embedded, it wasn't enough for our consumers to just buy. They had to ask the property manager, hey, what is this? For reference, our average policyholder is 55 years old. So it might vary I think your average policyholder is pretty similar age as well, so probably same experience.
So what I like about that answer is it suggests opportunity for a lot of customer experience innovation. You described that.
I think that's right. The thing is, there are a lot of people going around saying that they're building stuff that's embedded. It's not embedded. It's a cross-sell model. I'm sure that manufactured home guys have been referring to insurance companies before.
Absolutely.
And it wasn't a good customer experience, and it didn't have a high cross-sell rate. And you see a lot of this, literally every mortgage company is like, oh, we do embedded insurance now. You're like, no, you don't. You have an adapted insurance agency that's manually pulling levers to write this business as an agent. That's fine. It's cross-sell can be good, but it's not embedded. What I think when we say embedded, what we mean is it's an integrated customer experience where you sort of get insurance with one click. So the example of that Apple is legitimately really good embedded embedded insurance product. The claims are integrated, buying is integrated, it makes sense with the product. And that's kind of where we need to go with Adarsh's point. It's actually a really good part because you need to actually take into account the context of it and make use of it for this whole thing.